Hey traders! Welcome back to our channel. Today we're diving into a topic that's crucial for every aspiring trader: the common mistakes beginner traders should avoid. Trading can be incredibly rewarding, but it's also easy to fall into traps that can set you back. In this video, I'll be sharing the top mistakes to watch out for and how you can avoid them, so you can start your trading journey on the right foot. Let's get into it. The first common mistake most beginner traders make is using lower timeframe confirmation improperly. Let's look at this price chart example to see the mistake that most traders make and you should avoid. Most traders start analyzing the charts on the higher timeframe. In this example, let's use the 4-hour timeframe. Here, we see the price broke above the current swing high, indicating a change in market character and suggesting the start of a new trend. Most traders correctly identify the demand zone, where the price is currently sitting, giving them the opportunity to go long. However, this is where many traders make a crucial mistake. For extra confirmation, they transition to a much lower time frame, such as the 5-minute chart, and wait for a change in market character, believing that this is the extra confirmation they needed before executing their trades. But this is not the correct application of lower timeframe confirmations and may be one of the reasons why you keep losing in the markets. The problem lies in assuming that these two timeframes are correlated in a way that one can reliably confirm the other. Lower timeframes like the 5-minute and below are insignificant and should never be used as an extra confirmation of a higher timeframe structure. The market dynamics and participants are different on each timeframe, leading to discrepancies in price action. This mismatch often results in false signals and losing trades. Now, let's look at the right way to apply lower timeframe confirmations. We'll use a price chart example to demonstrate this. Our higher time frame in this example is the 16-hour chart. First, we had a break below the previous low, signifying that sellers are still in control. Next, we identify this supply zone where the market is currently sitting, indicating potential selling opportunities. The primary reason we use lower timeframe confirmation is that this internal structure contains strong bullish momentum, which we don't want to go against. So, we need to ensure this bullish momentum is depleted before executing our sell orders. Let's transition to the 4-hour timeframe to get a clear picture of this internal structure. Here, we can see the swing low of the internal structure. For us to confirm that the bullish momentum is depleted, the price needs to break below this swing low. It's crucial not to rely on lower timeframes like the 5-minute chart for a change in market character, because a shift on such a low timeframe doesn't necessarily indicate the depletion of the bullish momentum in the overall internal structure. Be patient and wait for the price to take out the swing low of the internal structure for accurate signals. Once this happens, identify your internal supply zone and wait for the price to retest it. From there, execute your sell orders, and the price will most likely drop and reach your target. Let's look at another price chart example, this time starting from the hourly time frame. In this example, we had a break above the previous high, indicating that buyers are still in control. We then identify our demand zone where the market is currently sitting, presenting a good opportunity to go long. For extra confirmation, we need to transition to the 15-minute time frame to get a clear picture of the internal structure. Let me repeat this again: do not make the mistake of going into much lower time frames like the 5-minute or 1-minute chart for your change in market character. These time frames are insignificant, and a break from that structure does not mean that the internal bearish momentum is depleted. Relying on these can lead to false signals and loss of capital. We already know that to confirm the depletion of bearish momentum, the market must break above this internal swing high. So, be patient and wait for the market to break above it. Once this happens, it confirms that the bearish momentum is depleted, and we can proceed with our trade. Identify your lower timeframe demand zone and wait for the price to pull back and retest it. From here, execute your buy orders, and the price will most likely push up and reach your target. By following these steps and using the right time frame for confirmation, you can avoid unnecessary losses and increase your chances of successful trades. The next mistake I want to discuss is analyzing only on lower timeframes. This is a common error I often highlight to traders, yet it continues to happen. Some traders overlook the higher timeframes and jump straight to finding trading opportunities on the lower timeframes. They fail to grasp the significance of the higher timeframe, which often leads to false signals. Understanding the importance of top-down analysis is crucial. By starting your analysis on the higher time frame, you gain a broader perspective of the market's overall trend and momentum. The higher time frame serves as a roadmap, providing the bigger picture and helping you identify key levels and zones where significant price reactions are likely to occur. Let me show you how analyzing only on lower time frame can lead to false signals. In this example, we had a change in market character indicating the start of a downtrend, so we should be looking for selling opportunities. The market broke below the previous low, signaling that the downtrend is still intact. We then identified our supply zone for potential selling opportunities and executed our sell orders. This setup seemed correct based on the lower time frame analysis, but the market pushed to the upside, completely violating our setup and resulting in a loss. The reason for this loss is that you relied only on lower time frames to analyze your setup. By looking at the higher time frame, you can see that there was a change in market character indicating that the overall market direction is bullish. Additionally, there is a higher time frame demand zone at the extreme. This higher time frame structure confirms that what appeared to be a downtrend on the lower time frame was actually a pullback to retest the higher time frame demand zone before the market continued pushing to the upside. Professional traders who utilize top-down analysis executed their buy orders at this higher time frame demand zone, while beginner traders who relied only on lower time frames executed their sell orders at this lower time frame supply zone. This discrepancy is the main reason why this trade resulted in a loss. Always make sure to start your analysis on the higher time frames. On the higher time frames, look for two things. First, the overall market direction. Second, key higher time frame supply or demand zones. These two factors form the template for how you should approach the lower time frames. The next mistake I want to talk about is improper risk management. Many traders think they know what proper risk management is, but from what I've seen, only a few truly understand and apply this concept in their trading. The problem is that most of you are so keen on making huge profits with each trade you take, and that's the exact mindset that will prevent you from succeeding in trading. Real traders focus more on what they are risking per trade, and that's exactly what you have to do if you want to become a profitable trader. Let me demonstrate to you what proper risk management is. The key with proper risk management is that you have to take even risk throughout your trades. Let me make an example with a $100 account. For every trade you take in this account, you have to risk an equal amount throughout. For instance, we'll be risking no more than $10 in each trade. This means that to blow this account, you would need to take 10 consecutive losses, which is highly unlikely if you have a good trading strategy. Some might say, with such a low risk, it means I'm going to make low returns. I want you to always remember this quote by Will Smith: "You don't try to build a wall, you lay brick by brick and soon you have a wall." Consistency is key. One way to ensure you're taking the right amount of risk per trade is to use MetaTrader on your PC. If the risk is above your limit, you can reduce the lot size or adjust your stop loss. This way, you can easily maintain an even risk throughout your trades. To see how crucial risk management is, let's look at this example. Let's say, from the $100 account, we took a total of 10 trades. Remember, we risk no more than $10 per trade and use a risk-to-reward ratio of 1 to 3. From the 10 trades, we had 5 losses of $10 each, resulting in a total loss of $50. We won the other 5 trades. With a risk-to-reward ratio of 1 to 3, it means we made roughly $30 per trade, totaling $150. So, from these 10 trades, our net profit is $100, doubling our account to $200. This demonstrates that you don't need a 90% win rate to be a profitable trader, you need to exercise proper risk management. Most of you usually lose 50% of your account in just one trade, which leads to emotional decision making and eventually blowing the account. However, with proper risk management, each loss will be manageable, allowing you to reflect on and understand why you lost that trade. This continuous improvement will enhance your trading strategy, and eventually, you'll start making a lot of money while still using proper risk management. My advice to you is to get rid of the mindset of wanting to make huge profits from a small deposit. If you don't, then trust me, you will continue to blow those accounts. Proper risk management is the key to consistent and sustainable trading success. The last mistake I want to talk about is not trading in line with the momentum of the market. No matter how promising your setup may seem, if you are going against the market's momentum, you will definitely lose. It's crucial to know when the market's momentum aligns with your trade and when it is against you. This way, you will avoid unnecessary losses. Let's look at this price chart example to show you what I mean. First, understand that once the price breaks below this previous low, the further it pushes to the downside, the more it loses its bearish momentum. Eventually, the price will have to pull back to retest a point of interest and regain its bearish strength to continue pushing downward. The rule here is simple: after the price breaks below the previous low, you should never go to the lower time frame to look for further selling opportunities because there isn't enough momentum to keep pushing the price down. So, when you transition to the lower time frame while the market is in a phase of exhaustion, no matter how good a setup may seem, since there is not much selling pressure, the market will most likely break above and take you out of the trade. Instead of looking for selling opportunities here, I usually stay away from the market and wait for the price to break above the local swing high. This indicates the start of the pullback, and it is much safer to start looking for short-term buying opportunities because the bearish momentum is depleted. Identify your demand zone and wait for the price to pull back and retest it. From there, execute your buy orders, and the price will most likely respect your setup. Once the price reaches the higher timeframe point of interest, the bearish momentum is restored. You can then execute your long-term sell orders, and the price will most likely shoot to the downside. As the price pushes downward, it is safe to look for lower timeframe selling opportunities because there is still a lot of selling pressure in the market. However, once the price breaks below the swing low, stop looking for lower timeframe selling opportunities because the market enters a phase of exhaustion. This strategy ensures that you trade in line with the market's momentum, maximizing your chances of success and minimizing unnecessary losses. That's it for today's video. I hope you found these tips on avoiding common trading mistakes helpful. If you enjoyed this video, please give it a thumbs up, leave a comment below, and don't forget to subscribe to the channel for more trading insights and strategies. Until next time, happy trading.